Cat Tractor gets absolutely crushed today when they release their earnings. Nvidia doesn't do much better. We have a huge week of earnings reports coming out this week. Plus, I want to talk about something that's happening on the S&P 500 that has happened less than 10 times in history. I want to talk about what it means. Here's a disclaimer. You know, it's markets like this that get me pumped as a trader. We're going to start off with the Dow Jones Industrial Average here in just a second, but I just want to say, when it's a bull market and all you have to do is just buy long and hold and make money, that doesn't take a whole lot of skill. It's wonderful. We can all make a lot of money that way, but days and weeks like we've had over the last, 5 to 7 trading days, that is what trading is all about, and that requires skill and technique and knowledge and experience, and it just really gets me jacked. I get excited about it. So getting into the Dow Jones Industrial Average, one of the things we were looking at last week is the fact that this has been so range bound. What I did was I drew some support and resistance lines here, and we talked about how we needed to break out of this range this week. That's one of the things that we were wanting to see, was a break from this range. We were hoping that we would get that today. I'm going to jump over to a 4-hour chart just to show this a little bit clearer. Yeah, let me zoom in here. This will help. So this is where I drew the support resistance lines in a video last week, and I said that hopefully on Monday we would break out of this range. Well, guess what? That did not happen. We fell this morning. Some weaker than expected earnings came out for Cat Tractor, followed by Nvidia. We fell, the Dow fell about 400 points. We were still not able to make it out of this range. So for now, we're still range bound. But what is our expectation? And one of the things that I talked about last week was looking at oscillating indicators that have ranges on them. This is a stochastic slow. Just to show for anyone watching who wants to mimic this indicator, it's just a stochastic slow. Stock as in just how it comes by default. It has 14.3331, and I'm looking at the percent K, or slow K right here that's highlighted in teal, and this is high on its range. It's on the overbought range. And so what I'm saying is when we're range bound here, we can look at indicators like this to help us determine what the next likely direction will be. My guess, where I thought the probabilities were highest, were that we would fall out of the bottom of this range based on how high this indicator is. If I zoom out and we look back at previous times whenever this indicator was high, such as here, we had a price decline. Here, we had a price decline. Here, led to a price decline. So the next series of events will most likely be a price decline. I also pointed out the fact that we had a bearish meaning down divergence forming right here. We had a new high placed by the Dow that was not placed by our stochastics. It was a lower high. That is what is known as a bearish divergence and leads to downside swings in price movement. I covered all of this in the video this past Friday. If you want to learn more about that, then take a look at that video, but for time's sake, I'm going to move on. So let's talk a little bit more about today and what happened today. I'm going to zoom into the price action. We're going to zoom into this box right now. All right, so one of the things we were looking at last week was this bearish divergence. I was saying that it was a potential bearish divergence, and what I mean by that is that potentially we could have a cross. Do you see where this line right here is crossing this line and the teal line is crossing the red line? That's confirming a cross on our stochastic. And so last week at the close and on Friday, the teal line was above the red line. Well, today after the first candle, it is actually confirmed a cross lower. Okay, so this is a confirmed bearish divergence. We're talking about stock market here. Okay, there is nothing that's 100%. We're always dealing with probabilities and trying to guess and put as many things on our side of the ledger as we can. So the market can do whatever it wants to. I'm always going to state that. This price could blow through the top here, and I'm actually going to talk about a scenario where that could happen. But for now, we have locked in a bearish divergence. It's a very bearish signal. There's a couple more things I want to dive into. When you're looking at a charting time frame, we're looking at a 4-hour time frame here, and you can't really figure out what's going on. A lot of the times it's helpful to either zoom out, meaning look at a larger time frame such as the daily, or zoom in and look at the smaller time frame. Now typically the larger time frames are more powerful, but they take longer to manifest and play out. So if you want to see what's going to happen in the short term, you look at smaller time frames. If you want to see what's going to happen over the long term, you look at larger time frames. Here with the daily time frame, there's nothing new here that we didn't have last week. We're still looking at more of a down style trend to the market here. We have not been able to break that down trend line. We're high on our oscillators here. We did have a weakening histogram on our MACD today. That's another bearish sign, but that makes sense because we had downward price movement. However, the price fell and the bulls came in and bought, driving the market up past the session lows. We're going to talk more about that, but we need to dive into a smaller time frame. There's a time frame that's not very popular. I personally love using this time frame, and it is a 20-minute time frame. I'm going to show you why. Alright, here I have the same channels drawn that I had on the larger charts. Alright, so here we're zoomed into the price action. This is now a 20-minute chart, so you can see the high side of this channel and the low side of this channel, and we have been range bound. But I want to talk about what we did today that is significant. But to do that, I need to dive into how price action works a little bit on the charts. So to look at the price action, I'm going to actually need to draw a little bit on the charts. So I'm just going to snip this area out right here. I'm going to show you a little bit about what I'm talking on here. So if we take a look at this price action, lows in an uptrend typically will go higher. What I mean by that? What I mean is that an uptrend is characterized by a series of higher lows and higher highs. That's a much better way to say that. So if we take the low of our stochastic here and we draw a line, we take the next low of our stochastic, we draw another line, you see how this low on our stochastic was higher than the previous. Alright. Now we don't have a whole lot of lows going on with the stochastic, but if we just come here and just look at the price action, what you can clearly see is that this low was higher than this low, which was higher than this one. Okay. I'm going to actually draw so what we did was we moved up, we came down, we put in a lower high, we then moved up, we put in a higher high relative to this high, and then we fell down today. What was significant about what happened today was we actually put in a lower low. I'm going to say that one more time. We placed a lower low. This low here is lower than the previous low. Okay, so as we go up, we have to try to figure out what's more likely. Will we put in a higher high and continue the uptrend? Because this trend has been consistent since December 24th, since Christmas Eve, December 24th. This series of higher lows has been taking place over and over and over. Well, what happened relative to our lows on our indicator, this is what I'm looking at, we placed a lower low than the previous low. So what we have to try to figure out is, what are the chances, looking at our price action here, what are the chances that we actually put in a higher high? So tomorrow there is a possibility that we actually put in a higher high, but what are the chances that we do that? So to do that, what we'd have to do is we'd have to see a move that surpassed this previous high before this indicator could turn over and draw us lower. So as you can see, this indicator is already in an overbought situation, but the price is only right here. So if this price were to rise, say slightly in the morning and then turn over, our next likely area of support would be the bottom of this channel. So tomorrow, all eyes will be looking at this area right here. This area, which is the bottom of the channel. That is the most likely scenario from what I can see as to what will probably happen tomorrow. If we break through the bottom of this channel, then we are setting ourselves up for much, much lower. At that point in time, it looks like we would be actually starting our down move on the daily chart, and we would have broken through the bottom side of this area. If it holds as support, then we could be driving up higher. But we are very, very high on our range-bound oscillator, so that's kind of a hard scenario to imagine. But one of the things I want to talk about that could happen is if that area does hold as support and we drive higher, a lot of traders have shorts on right now. And what does that mean? They have shorted the market. So they have stop limits that are probably placed somewhere up here above recent price activity. So they have their stops placed, market stops or stop limits. And if the price were to drive up, say strong earnings were to be released later this week from Apple or Amazon, and it drives the price higher, then not only would we have institutional investors coming into the market driving the price higher, but people's short positions would be forced, retail traders would be forced to cover their short positions, and when you cover a short position, you buy to close. So that would also drive more price action, which could lead to a really large green candle. I'm not expecting that to happen. However, that is a very real possibility. What I'm expecting to happen, and again, it's only based on probabilities. I'm wrong about things in the market very frequently, but I always know how to pivot because I'm aware of all of the possibilities. What I expect to happen is that this indicator will digest and fall lower, and we're going to find support here at the bottom of this channel, and that's going to be make or break. We may see a scenario where we gap lower below this channel, rise, retest this channel, because what is historically support becomes resistance, and if at the time we retest this channel it holds as resistance, then we could be going lower. That's what I would like to see personally, but the market historically doesn't really care about what I like. I'm not going to spend very much time going through the other indices. They are very similar to the Dow. Here's the Qs, which is the NASDAQ. Same thing, looking at it 4-hour chart, we're starting a move down. We have a bearish divergence. If I look at the S&P 500, same thing, bearish divergence. If I look at the actual IWM, which is the Russell, same thing, bearish divergence. I can move over to a daily time frame. We're high on these oscillators, weakening, very, very weak MACD histogram. So, I mean, all signs are still pointing towards relatively soon we should be heading towards the downside, but you know, I don't have a crystal ball, just trying to make most sense of what I see. So this is what we're looking at in the general market. Let's jump over into some earnings. I want to go over a couple of things, just my opinion. So here's Cat Tractor. They released earnings this morning. You can see that they gapped down. It looks like they closed around $137 on Friday, and now they're down to $124 today. One of the things I want to point out is if you had to bet, and I do not recommend trading through earnings. I personally never hold a trade through earnings. Earnings are completely random in my experience. I've been trading for over 10 years, and I can tell you that a company can beat earnings and the price can fall. Company can miss earnings, the price can go through the roof. It all depends on how they guide, expectations, disappointment, surprises. I mean, it's just crazy. I'd much rather trade going into earnings or coming out of earnings if I'm using earnings as a catalyst. So the point is I'm not condoning trading through earnings, but Cat Tractor, if you had to bet on whether it was going to go up or down prior to earnings, if you just look at this right here, I keep talking about the range-bound indicators. I'm not in love with any single indicator, but it is pretty obvious if you look at the position of this oscillator that the price was overbought. It was overbought going into earnings. So the most likely scenario would be that it would go down next. Previously, when it was overbought, it went down. Previous to that, it was overbought, it went down. Not just because it's overbought, you can look at this area right here. Doesn't mean it's going to go down today, but it is like a yield sign that says, hey, the next likely direction is down. Okay, so that's what we were looking at with Cat Tractor coming into today. The reason I point that out is because I want to go through some other earnings that are coming up this week. We have Apple coming out, Microsoft, Facebook, Qualcomm, Amazon, okay, all of these, Tesla. All of these companies are releasing literally in the next 48 to 72 hours. I want to take a quick look at the charts just to see how they're poised going into earnings. First up, we have Apple. Apple's releasing earnings January 29th, which is Tuesday afternoon. They're expected to release earnings after the market close. All right, so the first thing that stands out to me, we talked about this just a moment ago, is where are we on the scale? We're high. We're high on the scale here on our stochastics looking at Apple. So if I zoom in, Okay, Apple had a big gap down, about an 8% gap here at the beginning of the year. One of the things that's really significant is that when I draw a horizontal line at the price in which Apple was trading prior to this fall, it will serve as a resistance line in the future. We've been able to trade up a little bit higher. We've been able to trade up a little bit higher this week and touch that line, but we have not been able to break through it. So that is a very clear area of resistance going into Apple's earnings. Again, Apple could blow out and we could see a huge green candle here with high volume. That is always a possibility, but it is interesting that we are very high on our range-bound indicators, and Apple has not been able to break through the areas that it was trading at prior to falling here back at the first of the year. Next, we have Microsoft, which is reporting earnings on Wednesday the 30th. They're expected to report after market close. Same thing here again. If I were to draw right here, taking a look at where we are with the price currently, we are high. We are verifying a down move. We actually have a cross. If we zoom in, we're going to zoom in here on the price. Say we're going to zoom in. Here we go. We're going to zoom in on the price. We have slightly red histogram. We're crossing going down. Microsoft is poised to trade lower. We're putting in a lower high relative to this high. If I were to draw a line here, that's our previous high. We are putting in a lower high currently right here. Okay, this is lower relative to this. We are high overbought on our oscillator, and it is verifying a down move. So this has been this has been range bound. Just like the market, a lot of these large companies are mimicking the market currently. This has been range bound, but we're at the bottom of the range, and it looks like momentum is building to break out to the downside. So again, earnings can be a crapshoot. But if I, just looking at what the evidence I have in front of me, it looks pretty obvious that things are a little bit more biased to the downside. Jumping over to Facebook, if I take a look at Facebook here, Facebook, same thing. Look how high we are on the range-bound indicators. So this has actually crossed to the downside on the MACD. One of the things I want to show you specifically on Facebook is that we had an area of support back here in March, late March of 2018. That area held as support and was an area for Facebook to be able to drive higher, higher, higher. We retested that area. It served as support a little bit, but Facebook broke through it on bad news, and then we've now risen back to test that area of support, and it is now serving as resistance. And recently, we have not been able to trade past this level. The level's right at about $150. So if I were to take this down to about 150 even, that is the magic level for Facebook. We cannot trade over 150. We've tried recently. We've been able to trade a little bit higher, but we can't close over 150. And so we're high on our range-bound indicators again. I sound like a parrot saying that over and over. But we're high on these range-bound indicators, and we're at 150, testing it as resistance. Looks like, to me, the next obvious direction is down. Lastly, we'll take a look at Amazon. Amazon is releasing earnings on Thursday the 31st. I think that's right. Yep, Thursday the 31st. After market close is when they're expected to release earnings, and I feel like I don't even have to say it at this point in time. Look how high this is. Okay, look how high that is. This is crossing, coming down. This is a lower high. Again, there is no crystal ball. There's no way for me to know 100% of the time what's going to happen, but if we just follow past tendencies, historical movements, the next likely direction for Amazon after it digests any earnings news should be to the downside. Should be. Don't know if it will. It may be worth putting on a trade. It may not. Depends on what your risk tolerance is. I'm just talking about what I see. Lastly, I just want to talk about this little charting nugget, just something you can take with you. Take it for what it is. I just want to show you what I see. Something that has happened throughout history. First, we'll look at major market declines. So first, obviously, the one that stands out to most of us was the financial crisis of 2008. So I'm going to zoom into that really quick. This is a chart of the S&P 500, and this is the monthly time frame. So we're looking at monthly candles. All right. So here in 2008, we see that the price broke through this simple moving average. This simple moving average has a length of 21 months. It's a 21-month simple moving average. This line is very significant because it serves as the middle Bollinger Band. The Bollinger Band indicator is a very, very popular indicator used for a lot of people that surrounds the price action. Well, the center line in the Bollinger Band is the 21-period moving average line, and when placed on a monthly chart, it is a 21-month moving average. But the point is that once this has been broken as support, it will typically act as resistance before further decline. So here in late 2007, late 2007, we can see that the price actually broke through this area. It came down, came back up, touched the 21-period moving average line. It acted as resistance, and then the price fell down into what we can now recall as the financial crisis. But first, it had to break through this line and then retest it. Prior to that, we had what was known as the tech bubble. The tech bubble built up in the late 90s, early 2000s, and then finally burst in 2001. So right here at the end of 2000, going into 2001, we had a break of the 21-period moving average line. The price came back up, retested this area before falling down into what we now remember as the tech bubble burst. So we broke through the line, then we retested, it held as resistance, then we fell further. All right. Prior to that, I want to go all the way back. There's a lot of instances here where the price came down, tested it as support, it held as support, and then it led to a bull market run. Okay, so that's what happens if it does hold as support. But I'm going to come all the way back to 1973. So bear market started here in 73. Zooming in to what happened in 73, we broke. In 73, we broke through, we retested, we bobbled around, retested, we were unable to break back above the 21, and then that led into well over a year of downward decline. All right, so that's what we were looking at in 1973. Lastly, I'll take us back to 1966. Pick 'em up sticks. All right, 1966. You'll see that the moving average line gets a little quirky here. I don't know how accurate market data is back to this area, but you get the point that in 1966 we broke this line, we retested it, it held as resistance, and then it fell. And this is a really nasty candle here in the summer of 1966. Why did I say all that? Well, obviously it's got to have something to do with where we are today. But if we come to where we are today, and we look at the S&P 500 price action, where we are sitting currently right now is that we have broken through that 21-period moving average line, and we are retesting it as we speak. So what goes on this week has far-reaching ramifications for the future. So will we continue to be bullish and drive higher, or will we break out of this range to the downside and start what could be the beginning of holding this line as resistance? I'm not going to insinuate what that means. I'm not saying we're entering into a historical bear market. That's not what I'm saying. I'm saying this is very interesting to see that we are retesting these areas, and it's very interesting to see if this holds, because this monthly candle will close in 3 days. In 3 days, the January monthly candle for the S&P 500 will be locked in place for forever, and it will either be higher than this line or it's going to be lower. If it's lower, it's very interesting that that is exactly what takes place before we move sideways and then into some of the worst bear markets that we've ever experienced. But more times than that, we've been able to break through, break higher, trade higher, which led to some of the best bull markets in history. So this looks like a very, very important pivot point to me. Okay, talking about this very specifically. We'll see what happens. I'll be watching, you'll be watching. Hopefully we can trade accordingly. Lots of indications between now and then. Lots of opportunities for prosperity if you know how to make money going up in the markets. Lots of opportunities for prosperity if you know how to make money going down in the markets. Making money going down in the markets just somehow feels good, and it happens faster. I don't know. I enjoy buying put options and making money personally. But either way, we're going to be prepared for what happens. Hope you have a profitable week. Hope trades go your way, and I look forward to talking again soon.